This is Henry Spil. It is good to be together. Would be better in person, but this is as good as it's going to get for the time being. Welcome and thank you all for coming to listening about taxes. What is the state of our tax structure, the IRS? Quite frankly, it's not good. COVID has really made a major impact on IRS personnel, staffing, and their work. So what IRS was told to do all of a sudden was send out the stimulus payments for 2020 and 2021. And what they literally did is they took their staff from one section and moved them to another section. And when the staff went to a new section, the existing work that was done by those people was never done. And they're just starting to catch up. The IRS has about 1 million pieces of mail in various service centers around the country that has not been opened yet, and that's only going to pile up. So time will hopefully work for them, and they'll figure out what they need to do, and hopefully technology will be their friend. So just a few comments. What I'm going to be talking about today is of a general nature. It is not intended to be tax planning for any specific person or any specific individual or situation. Obviously, you should see your tax advisor if you have questions with your situation. No two situations are the same and no two solutions are the same. This is a very personalized situation and business. Save your questions for the end and we'll take them when I'm done. And we should have time for me to go through my presentation and for you to ask questions. So let's start with just a little recap what has happened. In March of 2021, the American Rescue Plan was enacted by the president. There was 3 rounds of economic income stimulus payments, as they're called, EIPs, and 2 of them were for 2020, and 1 of them is for 2021. The one for 2021 is going to be addressed on the tax return. And if you received a EIP payment for 2021, it needs to be reconciled on the tax return. IRS said that they have mailed letters to all taxpayers that got those payments. It's about $1,400 depending on what your income is and filing status. When the IRS was processing 2020 returns and the economic impact payments did not agree with what their records show, they corrected it and sent a letter, and if you were owed money, you would get the money back, and if you got too much of a payment, you would be asked to pay it back. So for 2021, I've read, and I have been able to find it again, that they're not going to process the return. If it doesn't agree, I don't know if you're going to get a letter in the mail. They haven't really finalized that. And they're probably trying to figure that out as we go along. And so if you did get the EIP, you should be getting a letter 6475. And if you got the child tax credit, those advanced payments that started in July of 2021, you should be getting a letter 6475 that tells you what those payments were. And those also need to be reconciled to the tax return. Something new for 2020 and for 2021 is if you do not itemize, you can deduct a small charitable contribution deduction in 2021, 300 for single and 600 for married filing joint. A little something, doesn't hurt, and may lower someone's tax $5. And I'll be talking about charitable contribution deductions and documentation in a few slides coming forward. RMDs were required for 2021, and the new rule is you have to start taking RMDs by age 72. In 2020, there was a provision, if you collected unemployment benefits, the first 10,200 could be excluded. That is no longer in the law. So if you collected any unemployment benefits in 2021, they are fully taxable. I want to go back to the IRAs and the RMDs and talk about qualified charitable distributions. So if you call our office and say, I want you to send $5,000 to my church, we will do so. If you call up any IRA trustee, they will do so. So when you get your 1099-R, the amount that you've donated to the church is going to be included in gross distribution and taxable distributions. So let's say your total distribution for an IRA is $12,000 and $5,000 went to the church, you should only be taxed on 7, the difference between the 12 and the 5. And so it's up to you on your return to indicate that the 5 went to the church. The IRA trustees, Cetera included, is not responsible for reporting that to the IRS. That's the burden is on the taxpayer to do that. And if I prepare your return, I need you to tell me that. I've had over the last 3 years 2 letters that clients have gotten that are verifying the qualified charitable contributions. The letters come to, Mr. and Mrs. Taxpayer, on your return, you indicated $7,000 of qualified charitable distributions. Please send us the documentation to show that the money went to a 501c3 charity. And please respond within 30 days. So in each of the cases that I had, we responded, and then like a month later, we got a letter from the IRS saying, thank you for your documentation, no changes to the return. The purpose of that, from what I can see, is they probably picked maybe 50,000 or 75,000 qualified charitable distributions across the country, and they're checking compliance. And if the compliance rate comes back pretty good, they're probably not going to send out more of those letters. If the compliance on that was pretty bad and taxpayers couldn't support the qualified charitable distributions, they're probably going to start doing more enforcement action or change the reporting. So just a caution for that, keep your records, even when the money goes to a 501c3 organization. These are the tax rates for 2021. There are 7 rates. They are almost the same. They're exactly the same rates as they were in 2020, just a slight inflation factor. So, and they are the 4 filing statuses: single, married filing joint, head of household, and married filing separate. So depending on your situation, sometimes you don't have a choice. Obviously, if you're not married, you're going to be single. If you're married, I do want to mention that married filing joint is an election every year that taxpayers make. Just because you're married doesn't necessarily mean you have to file joint. In my software, I've got it set up for every joint return that I run the computations if married filing separate is more beneficial. And last year, and I haven't figured out why, for whatever the reason, I've had more married filing separate returns than I've had in the last 10 years. Because of the part that has to do with the income of the spouses. One may have been normal, the other one may have been next to 0. But that's an annual election, and it stands on its own each year. So here is actually good tax news. So let's just work with the column that says single filer. If you are single and your qualified dividends and long-term capital gains are up to $40,000, your long-term capital gains are going to be taxed at 0. This is a provision put in by Congress several years ago, and it's very, very really taxpayer friendly. This is a computation that you need to do in the last quarter of the year. So you see the numbers for joined is higher, and for head of household and married filing separate is sort of in the middle. And so this could decide if you want how much more money you want to take out from your IRA. Do you want to recognize capital gains or capital losses? And you could do this computation, but you've got to do it before December 31st. You cannot do the computation today for 2021. You can only do going it forward. And it's just a little involved. And I will tell you that software makes it a lot easier. And I've had 3 or 4 instances in December where I went over with clients whether they should take out more or less money from an IRA or recognize some capital gains. And then this chart also tells you that if you do have long-term capital gains and your income is on the high side, up to $445,000, you're going to be taxed at 15% and 20% over that amount. So just to be aware that if you do have high capital gains, it's not automatically that's going to be 15%. Qualifying dividends and long-term capital gains are considered one bucket for this purpose. Short-term capital gains and ordinary dividends are not. So qualifying dividends and long-term capital gains. When you get your 1099 dividends, it tells you total dividends and qualifying dividends is the next box. And that's where that information comes from. Standard deduction for 2021, $12,550 for single and married filing separate. For married filing joint and surviving spouses, it's $25,100. The IRS has announced what those numbers are for 2022. And just to give you an example, for 2022, it's going from $25,100 to $25,900. And if you are 65 and over or blind, you get the standard deduction becomes higher. So this change was made with the Tax Cut and Jobs Act of 2017 and was effective in 2018. So as a result of pretty much doubling the standard deduction, a lot of taxpayers are not itemizing because the standard deduction is higher than their actual itemized deductions. And particularly for a lot of people who are on the call that don't have a mortgage on the house, on their homes, that this is why they take the standard deduction. And IRS statistics have shown that the standard deduction, the use of standard deduction has really increased in 18, 19, and going forward. And from what I can see, it's going to continue to increase. So if you send like $1,000 or $2,000 to your charity, you may not get a tax break, but you do have an opportunity for tax planning if you want to bunch up your charitable contributions in 1 year and go over the standard deduction. So if you want to do something like that, you need to plan for it, and it can help you. You may want to speak with your accountant, and certainly if it's me, I will help you and guide you through how to do and give you some suggestions. And so as a result of this, what a lot of taxpayers are doing is they want to make a charitable contribution, a larger one than usual, but they don't know who they want to make it to. So they create a donor advised fund. And a lot of the brokerage firms have a donor advised fund where let's say you want to contribute $30,000 to it. So you contribute $30,000 to the donor advised fund, you get your charitable contribution of $30,000 at the time that you make the donation to the donor advised fund. Then you can pay out to your charities the amount in the donor advised fund. You could do it over 1 year, 2 year, 4 years. You can also add to it if you'd like. And then in the meantime, the money is invested and it could grow. So maybe if you contributed an amount, maybe by the time you deplete the account, it could be 10 or 15% more that money went to charity. And I think that's a good thing. Let's talk about state and local taxes. You have heard about this in the news a lot. You may have heard it through the acronym SALT. So the state and local tax deduction has been capped at $10,000 for married filing joint, $5,000 for married filing separate. And so in this $10,000 cap, is the real estate taxes on your residence and your income taxes, your state income taxes. So if you're a resident of Georgia and your real estate taxes are $7,000 and your Georgia tax is $5,000, you're going to deduct $10,000. And that's the limit. So there's been a lot of discussion within Congress, especially if you live in New York and California, where the real estate taxes are much higher than they are here in Georgia. Those taxpayers are really getting hurt. So Congress is in the process of deciding how to handle that SALT deduction going forward. We do not know what it is going to be for 2022, but I do need to tell you that it's a possibility that it may remain at $10,000. This is part of the discussion for the Build Back Better tax bill that the House passed and is in the Senate right now. The House raised the limit to a very high amount. I think it was 80,000. I don't know what the final resolution of that is going to be, and certainly don't have any timetable because Congress has got to make some determinations. The Senate's got to make its determination, then the bill needs to be reconciled with the House. So I think we're a ways away from getting some sort of tax bill for 2022. You've heard a lot in the news about virtual currencies. There is a question on page 1 of the tax return that needs to be answered yes or no. And that question is, do you hold virtual currencies? Did you buy, sell, do any exchange? Be careful if you use software to do your own returns. The software may have a default yes or no. I am finding from speaking with many of my clients, and particularly during 2021, that a good bit of my clients are going to be answering yes to the question because they have purchased virtual currencies, and Bitcoin is just one of them. So this is an area where the IRS has really stepped up its enforcement action, and they're looking for the holders of the virtual currencies to start reporting the transactions just like you get from Cetera or from Voya, that 1099-B. The IRS has ruled that the virtual currencies are property, and just like any other property, it has a basis. So if you sell virtual currency, you need to report that sale. You have made income, or you may have lost money. But if you use virtual currency to pay for a good and service, then you need to recognize that transaction on your tax return. So I just want to say, pay attention to what your software does to answering the question on page 1 of the return. There is a reason why IRS put that on page 1 of the return, because they're going to start focusing on it. And I think in the next year or two, the enforcement action on that is going to be much, much greater. So also, the IRS has put out the instructions for the 2021 tax returns for Form 1040. And in the instructions to this question, if you just buy and hold a virtual currency, you can answer the question no, that all you're doing, you're not required to say yes, that you have used it for exchanging of goods or services, or exchange it for another virtual currency. If you switch virtual currencies, that is a taxable transaction, and it needs to be reported. And what makes virtual currency just a little more difficult is computing your basis. I think getting what you sold it for could be relatively easy, but computing your basis at the time you purchased it, you need the documentation. Expect greater focus on this on IRS, and particularly more taxpayers are using it. Some people, I've heard from some clients, I just want to have a little fun with it and see if I can make a little money. Let's talk a little about estate and gift taxes. So the estate tax exemption for 2021 is $11,700,000. We do not know what it is for 2022 because that is going to be part of the Build Back Better. I've heard different numbers. No one has come up with a number. And I think we're going to need to wait for Congress to pass the legislation or tell us that the 11,700,000 is going to be indexed for inflation. So the increase in the exemption, even if Congress does nothing, ends in 2025 because it was one of the provisions enacted by the Tax Cut and Jobs Act of 2017. The annual gift tax exclusion is $15,000 for 2021, has been indexed for inflation for 2022 to $16,000. So here is the significance of these numbers. So any taxpayer can make a gift of, let's just use the 2021 numbers of $15,000 to anyone they want to. It doesn't have to be a family member. It could be anyone. And if it's a taxpayer, two spouses, they can gift $30,000 to one individual. Let's say that mom and dad want to help their son buy a house and the son needs $50,000 for a down payment. So mom and dad could give them $30,000, 15 and 15, and then give them the additional 20. So they would have to file a gift tax return to report a gift in excess of the annual exclusion. There's no tax to pay, but is a filing requirement. And also want to just jump in a little on 529 plans. If you want to help your grandchildren, and particularly with the 529 plans, you could bunch 5 years worth of annual exclusions at one time. So let's say a granddad wants to give $75,000 to his grandson's 529 plan, he can do it. You don't even have to file the gift tax return, although I'm not sure of that. But what that means is in the next 5 years, granddad cannot make a gift to that same grandson because he has already used the exclusion. So that's just one little thing to keep in mind about that exclusion, and where the 529 plans could come in handy, and particularly if you want to pay for education for a grandson. So this is an opportunity. We're talking about estate and gift taxes. For you, does your documents need to be updated? The laws may be changing. We don't know what it is. You should review any insurance provisions and see if the policies you have are still good or not. So let me read you a list of names. You'll all know these names: Michael Jackson, Bob Harley, Sonny Bono, Steve McNair, Abraham Lincoln, Pablo Picasso, Aretha Franklin. What do all these people have in common? They died without wills. And so what Aretha Franklin's estate is being administered, it's a public process. They're trying to figure out, what she owns, values, and her estate in particular, the valuation could be difficult, but it still needs to get done. And I'm assuming, I don't know anything about her in particular, but she may be over the $11 million mark, and there could be estate taxes due. And remember, before any distributions are made to any beneficiaries, you got to pay the estate taxes. And I have no doubt that her estate is on extension, and they're probably still working on it, and may even need to be amended. Michael Jackson's estate was just a mess. Don't be one of these people. Take care of your family, take care of your assets. Your assets should pass as you would like them. And certainly our office can help you with the process and minimizing income taxes and estate taxes. This is an opportunity to mention, for example, if you want to include charity in your estate plans, perhaps leaving the beneficiary of an IRA or part of an IRA to a charity is good tax planning, because the charity doesn't pick up taxes, doesn't pay taxes on the money distributed from the IRA. If you leave it to a family member, it is taxable income to that family member. So there are taxes, and there's planning opportunities, and there are ways to minimize all these taxes and at the same time achieve your goals. So, but you've got to step up to the plate and ascertain your situation and see what needs to be updated. If that Build Back Better bill is passed by Congress later this year, I think that is a good time to review your documents, will, trust, and see if anything needs to be updated. So let's talk about charitable contributions. So I mentioned that for 2021, even without itemizing, you could deduct 300 on an individual return and 600 on a joint return. You still have to have the documentation. Just because you don't itemize doesn't mean that you don't have the documentation. It must be to a qualified charity, and you must have proof of payment. Cash or non-cash of 250 requires a contemporaneous written acknowledgement from the charity before your tax return is filed. And that's crucial. And that is an area where I think IRS is going to be doing those letters, like I said, with the qualified charitable distributions from IRAs, because they're going to start monitoring that and see, and they may pick 50,000, 100,000 returns in the country that have large charitable contributions and see if the taxpayers have the documentation. There was a tax court case many years ago where it was no doubt that the taxpayer, husband and wife, donated the money to the church. For whatever the reason, the couple got picked for audit, and the agent asked for the documentation on the charitable contribution deduction, which was about $50,000 or $60,000. So it was no small donation. The taxpayers could not locate the letter of acknowledgement. So they went to their treasurer at the church and said, would you send me the backup on my donation? And so what the treasurer did is the treasurer printed out the Excel spreadsheet, and the Excel spreadsheet was printed with the current date. And the rules say that you need to have this documentation before you file your tax return. The deduction was disallowed. That's awful. So it's easy to get your documentation before your tax return. If you should be working on it now. I know a lot of the charities are sending those letters and schedules out and now, because I've received some of them myself. Don't let this slide. It's important. And you just never know when it's going to come back. Non-cash contributions of over $500, you need to fill Form 8283. And all of the information needs to be filled out. And it's not exact numbers that you can have an estimate. Like, for example, if you're giving away household furniture to Goodwill, you need to put down the date you gave it. You need to put down the value, how you valued it, and the value, and the cost. And it's not looking for an exact number. If you think it costs like $3,000, put $3,000. Do not leave that box blank. That's an invitation to get the deduction disallowed. If you donate non-cash items and non-publicly traded stock over $5,000, it needs to have an appraisal. The appraisal needs to go with the tax return. And there's certain rules if you donate art and those rules are important because you can't get the appraisal too much in advance from making the donation. If you give clothing and household items, the rules say must be in good or used condition. So this is a deduction that is for taxpayers that itemize. It's a lot of times for taxpayers, it is a tipping point that decides whether they itemize or they don't itemize. Little calendar of, this is my calendar, my tax calendar. March 15th is the due date for business returns, partnerships, C and S corporations, and that can be extended till September 15th. April 15th, we all know what that means. That is the due date for individual returns, and they can be extended to October 15th. And then if you have accounts outside the United States, you have to report Form 114. And that's also due April 15th, although if you extend your return, that's also extended. And then C corporations are due October 15th. They're due April 15th, and then you can get a 6-month extension. Trust and estate income tax returns are due April 15th, and they can be extended to September 30th. Note that September 30th, not October 15th. Only the individual returns are extended to October 15th. So just some changes for 2022 tax season, which is the 2021 tax returns. If you receive your child tax credits, you may get more. You may be entitled to more if your income decreased in 2021, or if your income increased, you may have to pay it back. And so you're supposed to get a letter 6419 from IRS, and then you reconcile that on the tax return and you report what you received. Then the recovery tax credit, the economic stimulus payment, that was the third payment that was sent out sometime in 2021. I want to say like April, May, June. And you should get a letter 6475 from IRS. If you have received a letter or you threw them out or you misplaced it, you may want to create a personal account with the IRS website so you can retrieve this information. I don't know right now how IRS is going to treat the returns where the information on the return doesn't agree to their records. I'm not sure if they're going to make the adjustment or they're just going to have the return on hold or send you a letter, you need to do something. That remains to be seen. But pay attention to those letters 6419 and 6475. And then I mentioned about the 3 and the 600 with charitable contributions that you don't itemize, and that's just for 2021 cash only, and you still need the documentation. Few reminders, these questions come up every year. You sell your house. It used to be that there was a rule that if you were over 55 and you had to reinvest the proceeds and go buy a bigger house. That law got changed in 1997. So now all you have to do, and this is very, very taxpayer friendly, is if you live in the house 2 of the last 5 years, you can exclude on a single return $250,000 or married filing joint return $500,000, and there's no longer a requirement to reinvest in another house. You don't have to buy a house. You can go rent an apartment, a condo, a townhouse. And so certainly for a lot of taxpayers that have been living in their homes for 40 or 50 years, the $250 for a single may not eat up all the gain. You still may have a taxable gain. So what you want to do if you're going to sell your residence and you've been there for a long time, you want to get your record keeping current and start building the basis for that house. You did improvements, you redid the kitchen, you redid a bathroom, you finished the basement, you did a new roof. All those things add to basis. Having the electrician or the plumber come in for a $300 job, that does not increase the basis. And you see and I see what real estate prices are doing. So it could be very well that you bought a house 40 years ago for $50,000 and you live in certain parts of town, that house could be worth $700,000 or $800,000 today. So you want to build your basis. So the higher the basis, the lower the taxable gain, because the $500,000 on the married filing joint return may not do it. I have a notation about special rules for widows and widowers. So if a couple lived in a house and they were in the year spouse number 1 passes away and they're eligible to file a married filing joint return, the surviving spouse has 2 years from the time spouse number 1 passed away to sell the house and use the $500,000 exclusion, not counting the fact that he or she is single at the time. So this is another provision that is very pro-taxpayer. So the widow or the widower has 2 years to sell the house and still use the $500,000. And that is important because a lot of times the primary residence is jointly held, so the surviving spouse gets a step up in basis for half of it, which would reduce the gain, and you may not need to pay any taxes. But still, my point is to track your basis, build it, particularly if you're looking to sell. And if a spouse passes away, you've got a good option to sell the house, use the $500,000 exclusion, and most likely not pay tax if the house was jointly held. So that is really good. But I just want to reiterate, there is no longer the requirement to reinvest, and you could do this every 2 years. If you're fortunate enough to find a residence that has a gain, then does not have to be the full 250 or 500,000. You could use this. You could use this 2, 3, 4 times in your lifetime. Talked about gifts to family members and using the 529 plans, but you just want to make the point that if you make a gift to anyone, family member or not, the gift is not a tax deduction, and the family member or the other person does not pick that up in taxable income. And so that is the definition of having a gift in our tax world. And if you're going to gift securities or real estate of a substantial amount, it's probably a good idea to speak with your accountant to just go over that transaction and see what the ramifications are, because there could be some planning that could be done on that. So this is protection. Let's just focus on the individual column. Shred your mail. Be careful with the phishing. Check your credit report and consider obtaining an IP PIN from IRS. So what that is you register with the IRS website, and they've been going through some updates and security clearances, and I'm not so sure that is working right now, but they said it will be. So if you e-file your return and the IRS has issued you an IP PIN, the return will not go through unless you enter that PIN number, the 6-digit number, on your tax software. So this adds a level of protection. And I guess IRS at one time has said we're going to issue everyone an IP PIN just to add to the security of tax returns. That has not happened. And so at certain points in the last 10 years, they were sort of strict on who would get those points. If you had tax identity theft, they would issue you one. If you just wanted one, they wouldn't issue you one. Then taxpayers in certain states can request one, and Florida is one of them, and Georgia is one of them, because those are the 2 states with the one of the highest tax identity theft in the country. So a couple things about Georgia. Georgia is pretty good when it comes for taxation on the state purposes. Georgia does not tax your Social Security benefits. Georgia does not tax your municipal income from Georgia bonds. It does tax your municipal income from other states other than Georgia's securities. Georgia does not tax interest and dividend income in U.S. government bonds, interest from Ginnie Mae and the Federal Home Loan Bank. So here's the big winner. Georgia has a retirement income adjustment. So if you're between 62 and 64, you get to deduct $35,000 of your income from your Georgia income, and that's per spouse. And if you're 65 and over, you can deduct $65,000 of your income, and that's per spouse. You don't automatically get the 35 or the 65. You have to have that much income. And if you have earned income like a W-2 or 1099, that's only limited to $4,000. These $35,000 and $65,000 provisions is the reason why most of you do not pay Georgia taxes. You do pay federal taxes, but you don't pay Georgia taxes. And now I'm going to open the floor to questions. And then let's see what the chat looks like, so I could start answering some questions and appreciate your feedback. So we'll just wait a minute or two and see if anyone has any questions. Anything I said that you'd like for me to repeat, or if something I didn't mention, you're welcome to ask. Someone is, if you would put your question in the chat box, that would, that way I can see it. Because if you raise your hand, we're not set up to listen to you. So that would be useful. The slide on Georgia income, can I put that back? Yes, give me a second. Next to last, okay. Okay, so that slide is up, and I just need to get back to the chat box to see what there was 2 items that were mentioned there. Credit card contribution is like, yes. So if you make so here's how the way that works. You are sitting at home on December 30th, December 31st, and you think you want to reduce your taxes for the year, you can charge a charitable contribution to your credit card and is deductible for that year in December. You're still responsible for getting the documentation, and if it's over $250, you need a letter of acknowledgement from the charity. So the question came up about using a donor-advised fund. So there are companies, the Community Foundation of Greater Atlanta, Cetera is one of them, that have donor-advised funds for this purpose. So what you do is, so let's say you come to our office and we will open up a donor-advised fund. And so you want to put in $20,000. So you get your charitable contribution deduction for $20,000 up front. Then you decide later whether you want to, who you want to make the donations to and when. So you would contact us and say, I want to send $1,000 to United Way. I want to send $1,500 to the Atlanta Food Bank, and it would go. You do not get the deduction when the money leaves the donor advised fund. So if the donor advised fund is invested and you may be able to donate more than you contributed. The question came up, how long will this fund last? And that's a real interesting question, because one of the provisions of the Build Back Better bill that's sitting in the Senate right now is Congress wants to have those donor advised funds liquidated within a certain amount of time, maybe 5 years or maybe 10 years. Based on the rules today, there is no time restriction. If you want to wait 2, 3, or 4 years, you can do it. Some of the provisions for the Build Back Better also saying Congress wants you to donate maybe 5% or 10% of the fund on an annual basis. So that is something to consider. It could be very helpful, and it could help you reducing your taxes. So we are ready for more items that you may have. The question came up about standard deduction for surviving spouses. Okay, so 2 spouses are married and spouse number 1 passes away. So for that year, in the year that spouse number 1 passed away, that couple will be filing a married filing joint tax return. And so if they were both 65, they would get the standard deduction plus that $1,350 that I showed on an earlier slide. So that's for the standard deduction for then the following year, assuming the surviving spouse is not married, he or she would be single. The question came up about where do you take that 62 to 65 retirement deduction on the Georgia return? It's on Schedule 1 of the Georgia return. It's, I believe Schedule 1 is 2 pages and is on page 2. Typically, if you put your date of birth on your tax software, they should do that automatically. I appreciate the feedback that I've been getting on today's presentation. It will take about a week for our office to put today's presentation on the website, and an email will go out to everyone saying that it is available on the website. So we still got some time for any other questions that anyone wants to ask us anything. It's okay to try to stump me. I'm up for the challenge. Will the slides be available? We can send those to you. Just send Mary in our office an email and the slides will be emailed to you. We're glad to do that. I appreciate the feedback. Thank you all. This has all been is very good. And I do appreciate the feedback and your participation and listening. So we're just going to hang on. Another question, does the donor advised fund have to be a separate account? Yes, you cannot commingle it with your current assets. It needs to be a separate account with a trustee. Our office has put together a new book on charitable contribution deductions, and we just got it actually yesterday. And it's in there. We talk about general rules for deducting charitable contributions, and we also have a discussion on donor advised funds. So if you would like a copy of that book, send Mary in our office an email, and she will put one to you. So the question came up about the 300 and 600 for charitable contributions. So this is in addition to the standard deduction. This is what Congress did in order to encourage taxpayers who do not itemize, which is the majority now, to contribute to charities. So you're entitled to your standard deduction. So if you're single, you're going to get you get that deduction in addition to the standard deduction. The question came up, if you cash savings bonds, will you get a 1099? The answer is, of course you will. And that's ordinary income and ordinary interest income. The good part about that is because it's U.S. Government agencies that is not taxable in Georgia. We'll just hold on a few minutes. Can you still sell your house and reinvest in another one? Yes. The answer is you can, but if you have a taxable gain, you have to pick up and pay the tax in the year of sale if the $250,000 or the $500,000 exclusion is not enough. So this is where it's important to build your basis, get all your records, and get your basis as high as possible. So, but I do want to reiterate, it is not a requirement to reinvest the proceeds from the house of a sale. You can go rent anywhere you want to, and you certainly can buy. And if you sell your house for $750,000, you can go buy another house for $300,000 or $400,000. The question came up about gifting from both spouses. Does one spouse gift? And yes, if one of the spouses passes away during the year, then no more gifts can be made for the spouse that passed away. The other spouse can continue making gifts, but is only limited to the one annual exclusion as opposed to two when both spouses were making the gifts. So we'll just hang on a little more, see if anything else comes up. So no further questions are coming in on the chat box. One last question. So how clinical can you be about the cost basis of a house? Well, certainly the closing statement when you purchase a house is your starting point. Then if you added to the roof, if you redid the basement, if you redid the kitchen, if you redid 1 or 2 bathrooms, all those items are part of the basis. Having the plumber come in to repair a leak for $200, $300, that is not basis. The termite bond, that's an interesting one. I would say that that probably is not part of the basis, but I would have to take a look at that. That's just my first impression. Security improvements would be part of the basis, and particularly if you get windows that are shatterproof and storm windows, that sort of stuff, all windows would be part of the basis if you change the windows. So please keep your questions coming. Anything else that we can help you with, we'd be glad to do it. So nothing else is coming through, so we are going to end today's session. Thank you again for participating and for listening. And if our office can help you with any questions, there's one phone number to call any of us, and that is 404-257-8811, and we're here to help. Have a good day, be well, and be safe.